Good morning.
So I'm Sanam Solati Yurczyk with New England Prestige Realty.
And I'm Kelly Turner with Total Mortgage.
And today we're going to talk a little bit about
what is going on with the feds and why now is a great time to buy a house.
It's a really great time. So last week there was some exciting news that was announced.
Yeah, we've had quite the last couple of weeks in the market. So as you may know, there was a Fed announcement with another interest rate increase, which caused some market turmoil. And as expected, as the Fed increases the interest rates, mortgage rates don't follow it exactly.
No, everybody thinks it does that.
Yeah.
Everybody thinks, oh, they raised them. The Feds raise the rates. Of course, interest rates are going to hike.
Well, and the same thing happened during COVID, where when they went down to zero, people were like, oh, well, that means my interest rate's zero. And I'm like, not quite. Now, it feels like those rates were zero at this point.
Yes.
However, there is what they actually both interest rates and mortgage interest rates, what sort of sits in between them is the 10-year Treasury bond, which is a sort of index that we follow. And as it goes up or down, we tend to find interest rates follow it. What was interesting last week is that after we had that, we saw some more rate volatility, and that's been kind of the name of the game.
That's the word of the season.
Yeah.
Volatility. Like that's all we hear.
Volatility. I would say the two words that I would use to describe real estate in 2022 was tension and volatility.
Yes.
Those were our two words.
Those are great words.
But then what was interesting on Thursday is an inflation report was coming in, and we did expect inflation to fall a little bit, but then it fell more than anticipated. So generally when these reports are coming out, both the interest rate hikes and things like the job reports, CPI reports, we kind of know what's coming before it comes. So the markets are actually already reacting to them. So interest rates are already taking them into consideration. But when something comes in better or worse than expected, that's when we see the big volatility, the big spikes or drops.
It's very reaction based. It doesn't seem like it's, I don't know, very
steady. No.
Like, I don't know. I feel like there could be a better way to handle all of this.
Probably. But what happened on Thursday was with this inflation report came in better than anticipated. We thought we were going to come in at 8% inflation. It came in at 7.7. And what it did is it actually gave a big boost to the mortgage-backed securities, to the 10-year Treasury. And we saw a really great drop in interest rates on Thursday. Now, when I say that, I had people like, oh, are they back to fours? No, my friends. No, they're not. But in comparison to what they've been looking like, we did see some really great improvement. Now, the downside to that on Thursday was Friday, the markets were closed for Veterans Day.
Yep.
So then the markets had 3 full days to marinate over this news, for people to talk, for some of the people in the Fed to make comments that were not really what we were hoping them to make. And that did cause some further reactions this week. So we kind of call it taking and giving back. So we gave back some of the wins that we had on Thursday, and then we got them back again. And that's kind of how the week has gone, is that some of the gains have been returned, some of them have come back. So we're still in a better spot than we were earlier in the week last week. So rates are still down a little bit. Are you going to see any enormous improvement at the moment? No, rates are not again back to 5s or 4s or 3s or anything like that. But what it does indicate to us, and I think it's the most important piece, is we think the corner may have been turned.
Yeah, no, I would agree with that. I think there's a little bit of a lag time with everything, kind of like when you're riding a roller coaster, the people going up, like once they hit that middle, they start to go down, but these people are still going up too. So yeah, there's definitely a little bit of a lag, but why are the interest rates so tied into inflation? Like, do you want to talk about like how far a dollar will stretch?
Yeah, absolutely. So inflation is really the cost of doing business anytime that money is being exchanged. Now there are the actual inflation index is measuring sort of these parameters. And then there's other indexes that are measuring other parameters, but just generally, if inflation is high, your dollar is going to go less. So it's worth less money. We tend to think when we say inflation, people automatically go to like the milk, bread, and eggs. They're not actually a part of the inflation index.
Because there's no control over that, right? If there's a storm out west, it can impact our food supply. So
But, as things become more expensive, everything sort of increases with it because your dollar goes doesn't go as far.
Yeah.
So while you watch the price of eggs go up, you're also watching the price of homes go up. You're also watching the price of rent going up. Everything sort of follows suit. Now, some of that is real. It's the supply and demand. Some of it is artificial. If everybody's charging more, then I can charge more.
Why not?
So that also drives the prices up. But as inflation, and Sanam and I've talked a lot about it because it's been my big mantra for months now with as soon as we watch inflation come under control, we're going to watch everything. It's unfortunately for us, rates spiked really fast. We're not going to see the same drop. So we're not going to see every home prices and rates plummet accordingly. What we're just hoping is that they've topped, and we're just going to see, instead of going down, we're going to see things go up and then slowly stabilize and head off. That's what we want. If we had a drop, that would be called a meltdown, right? That's kind of what happened in 2008.
We keep saying that's not where we're at.
And we don't anticipate it.
No.
It's really not what we anticipate. We think the volatility, for the first thing is the volatility is going to slow, and we're going to start to see rates stabilize. High, but stabilize. And then we're going to slowly start to see them go down. That's our hope. That's what we're hoping for.
Like what helped cause the inflation. And we had this conversation earlier. Like most people don't realize this, but out of every $17, about 16 of those dollars are used by credit. Like it's on credit. So if you go to buy a car, it's a $50,000 car. That doesn't mean you're necessarily putting $50,000 out of pocket. You're financing a lot of that, and you're paying your monthly payments. And so people that maybe had the cash, they were using financing. They weren't utilizing their cash.
Yeah, they were stockpiling their cash in investments in other areas because borrowing was cheap.
It was so cheap. It made sense. Absolutely.
Yeah. So, and the other thing that happened as well, and I was telling Sanam about it, is unfortunately, I also think some of these credit indicators are not quite as accurate as they once were. You used to use credit because you didn't have the cash. That was the purpose of credit. You were buying a $200,000 house. You only had $50,000. You didn't have $200,000, so you borrowed the rest of it. You were buying a car. You were using credit at Christmas, things like that, because you were buying outside of the cash you had at hand. Credit is actually used very different now. It's actually a strategy as opposed to a necessity.
Yeah.
So what do we use credit for? Like I have a credit card that I get points, which then turn into travel dollars.
Yeah, you do. I'm a plastic girl. I don't carry cash, period.
Yeah. So you're using credit even though you have the dollars. Yeah. And that really came into play a lot in the last 2 years when interest rates were so low. It was cheaper to borrow money and to use credit than it was to use your own money. So people were sitting on stockpiles of cash and not using it. And that's part of what was driving up inflation.
Yeah. And so with inflation, with the Fed rate cuts or hikes and all this, like they're basically trying to control what we're doing with our money. And like right now, rather than people going out and spending, like it's easy for them to actually put money into CDs and make like 5% interest.
Yeah.
That's steady and guaranteed. And again, this is just another way of just controlling all of this.
Exactly. And what does this all do to housing, right? So that's really where we come into play is how does all of this come into play with housing? Well, we saw in the last 2 years that rates were very low. Yes. And what did that do? That drove home prices up because lots of people flooded the market saying, ooh, I can buy a home. Now, some of those people were our traditional first-time home buyers, people getting into the market, but also a lot of investors hopped into the market as well. And they were buying what traditionally were homes for primary residences. Yes. Single family homes. This is the Airbnb flood that sort of came in the last couple of years.
Didn't you mention, do you remember the stats on how much Airbnb rentals have dropped a little bit?
Oh, it's like 50%. Airbnb is actually if you look, what did he say? The CEO of Airbnb made some announcements just this week. I wish I had looked them up about them trying to kind of get this going again because there's a lot of volatility in Airbnb because the market, what happens, right? Everything is supply and demand.
It's a domino effect.
Yeah. A huge glut of Airbnbs came in. Now the supply and demand isn't there. And a lot of the investors, historically Airbnbs were people who owned them. These were their vacation properties. They were well cared for, well-maintained properties. Now you have investors buying up properties sight
solely
unseen,
as a business.
Solely as a business being managed by third parties. And some of them are not nice, they're not clean, they're not well kept, they're not well managed.
And all the like maintenance fees on top of it, sometimes they're not as affordable as
or
hotels.
Profitable. Yeah. And they're not as profitable as people anticipated them being. So that also helped increase sale prices. So now what's happened, right? Now we have the
reverse
is kind of going on as we watched interest rates go up. It has taken a long time to start to impact those sale prices. But what are you finding?
So again, there's still low inventory. So right, as long as inventory remains low, we're going to see it's still like a stronger seller's market than it is a buyer's market. But the reason why now it's an excellent time to buy is you're not competing with as many people. So we're based in Glastonbury. Over the past few weeks or months or whatever, if you've been tuning in, you've been hearing, I've been saying that the average active homes for sale in this town have been around 40, 45. Well, I looked this morning and it's at 49.
Which is a little improvement.
It's a little improvement. But until we see a lot more inventory hit the market and then stay that way for at least 6 months, we're not going to see a great shift, right? But again, moving into these winter months, there's the buyers that are out there are serious buyers. But we have seen some of the buyer demand drop a little bit because the interest rates are scaring them. Rather than being scared of the interest rates, again, the cheesy line, date the rate and marry the house really comes into play here. And we were talking earlier about options like a 2-1 buy down. Do you want to kind of like on the surface talk about like what that could mean for a buyer and how it might help in this market?
Absolutely. Well, let's just talk a little bit about mortgages in general that in the last couple of years, the vast majority of people taking mortgages have taken 30-year fixed rate loans. And that's kind of been our standard for quite some time. Adjustable rates have not really been a thing. It's really been a 30-year fixed rate, regardless of program. With this increase in interest rates and shift in market, what we have seen is things like ARMs, adjustable rate mortgages, and 2-1 buy downs and other rate buy downs come into play. And what do these mean? So an ARM is an adjustable rate mortgage. You have a shorter term, but at the end of a certain term, the rates will go up. Those were very big in the early 2000s. They are a little bit of a contributor of the 2008 housing crisis.
And they're still great though, like if you're not going to be in your house for a long time.
Correct. And that's when we generally utilize them. And they're also better than they were in the early 2000s.
Sure.
They're better managed. They are better qualified. I think borrowers are better educated on them. So when you're taking one, you kind of know what you're getting yourself into, where that wasn't really the case in 2001.
But also in 2001, lending standards were very different than what they are today.
Much simpler.
Now it's a lot harder to get a loan.
Exactly.
You really have to be very well qualified.
Now the 2-1 buy down is actually where a seller, so not the buyer, but the seller can pay a concession. Okay. So they essentially give money back into the transaction, and that rate temporarily buys the interest rate. That money temporarily buys the interest rate down for the buyer. Generally, it goes down 2 points for the first year, 1 point the second year, and then it goes back to whatever the qualifying rate was for the third year. And the hopes in this are you'd have that rate anyway. Okay, whatever the higher rate is would have been your rate.
So let's say it's 7.5.
Yeah, that would be your rate if you were buying. You can get relief for the first 2 years. And then the assumption is that interest rates will either be the same or lower by the time this kind of loan is underway. You can always refinance it at any point in the 3 years. So if a year from now the rate comes down, you can refinance, and whatever's left of the buy down can go into your new rate. So it can go into your new loan.
And what's beautiful about this is now sellers are being a little bit more flexible and a little bit more giving. You know, before the pandemic, a lot of buyers would see some of the sellers help with closing cost concessions. So now they can help with the 2-1 rate buy down. You know, options are available.
And that's a conversation that we've been having with some of our buyers who are also selling, is that put yourself in the buyer's shoes. What would you rather? Lower the sale price or give a concession? It doesn't really make a difference to the seller.
No, at the end of the day, they're going to walk away. Whatever the seller net is going to be the seller net. But if it helps get the buyer into the house and the seller walk away with their cash, why not?
Why not do it? You know,
we do see some sellers that just don't concede anything for whatever reason. I don't get it. But for the most part, most sellers are open to the concept.
Yeah. And I think as we move into these winter months, we are going to find a little bit more of creative lending strategies that people are going to use. I also think that, again, as this demand diminishes like a little bit, not a lot, but a little bit, we are, and rates again have improved. We're going to see the market just loosen up. And this is, again, it's that corner turning that we've been like, everybody in lending has been like waiting for. It's just, we needed it to turn. We saw it with inflation. Now, what do we think is going to happen with inflation? 1 month of improvement does not equal improved inflation. No. We do need to see it consistently. And part of that is because when you're locking an interest rate today, the bank it's not about what it looks like today. They're taking into consideration everything they may think is going to happen between now and when you close on that loan.
30 to 45 days
30
later.
to 45 days later. So they're already contemplating in this period of time, there's another Fed rate increase. There is more job reports coming out. There's more inflation reports coming out. So they're thinking more long-term. So what happens with that is once we start to see a pattern of positive news that inflation is kind of getting a grip and coming under control, that's when we're really going to start to see again that slow leveling off in everything. So we hope
we're
that
very
it's
optimistic.
doing it. That the turn has really happened.
I mean, we're seeing it even like with all the supply chain issues, like during COVID, all we kept hearing again, there are supply chain issues. You can't get this on the shelf. You can't get this product or supply. Now it's all like loosened up. We're seeing actually some places have oversupplies of some things.
Absolutely. You know, so I think it's headed in the right direction. The Feds are the guys who really know, but they've had mostly positive things to say about, again, they feel like it's getting under control. And I think that, you know, do you want to wait? Because that's the other big question is, do you want to wait till rates drop?
You might be waiting forever.
Yeah.
No, not for the rates, for the homes,
for the homes.
Yeah. For values to drop.
Values to drop.
You will eventually see rate relief.
And I think, you know, it's just the time in which you need to purchase a home is not dictated by outside forces. And that's just something we always have to remember is that what is happening with all of this stuff doesn't dictate what your housing needs are.
Correct.
And it's just doing the best that you can at that time, making the best choices you can for your family at that time with professionals who are going to give you good advice, good feedback, and great
options
knowledge.
And just options. Everybody thinks there's only one way to do it. There's so many different ways. It all depends on your needs.
Exactly. So I think I was thrilled this week and last week we were really excited. But I think that the tide is turning, and what you don't want, because everybody always waits for the bottom, you will never get to the bottom if you wait for it, is if you are thinking it's time to hop on the ship. If yours is somebody who's saying to me, well, we think we're going to buy in the spring, my friends, now is the time to get started.
Now is an amazing opportunity.
Yep. It's an amazing opportunity. Even if you're not going to purchase till the spring, let's get you set up for that. But get set up that way. If the right opportunity comes across in the next couple of months, you're there and ready for it. Because a lot of people are waiting until the spring.
Yeah. And then it's going to be off to the races.
Yeah. It's going to be, we're going to be back to 20 offers on a house.
Exactly. Well, guys, thank you so much for watching. If you guys have any questions, feel free to reach out to us and maybe we'll talk about it in one of the upcoming segments.
Perfect. Thanks.